Capital gains tax is a tax that was introduced in 1st January 2015. It is a tax that is chargeable on the whole of a gain on transfer of a property situated in Kenya, whether or not the property was acquired before 1st January 2015. That is to say, if you acquired a property, even if it is 15 or 20 years ago, but you are selling the property anytime after 1st January, that is after the capital gains tax was reintroduced, then it will be subjected to capital gains tax. Capital gains tax is administered in accordance with the provisions of Section 32F, read together with the 8th schedule of the Income Tax Act. The rate of capital gains tax in Kenya is 5%, and it so happens that it is the lowest in sub-Saharan Africa. It is the final tax. That means that it cannot be subjected to further taxation. When we talk about property with regard to capital gains tax purposes, it is land, building, and shares. And shares are those that are not listed in the stock exchange. That implies that any shares that are listed in the stock exchange do not attract capital gains tax effective 2016. The taxpayers who are liable to pay capital gains tax are residents or non-residents transferring property, and can either be an individual or a company. A transfer is where a property is sold, exchanged, conveyed, or disposed of in any manner, including by way of gift, or on occasion of a loss, destruction, or extinction of a property, whether or not compensation is received. Another example of a transfer is on abandonment, surrender, or forfeiture of a property, or on the expiration of rights of a property. The net gain is the excess of the net transfer value less the adjusted cost. And here we have applied two terms, transfer value and adjusted cost. So to explain, transfer value is the amount of consideration for a transfer of the property less the incidental costs. And adjusted cost is the cost of acquisition or construction of that property plus any direct expenses for enhancing that property or for preservation of the title. Incidental costs that relate to transfer value are, for instance, advertising of the property, legal fee that will be incurred for the transfer of the property, valuation fee for the transfer of the property, and even commission paid to the person who is advertising your property. And for adjusted costs, the incidental costs include also legal fee, stamp duty, and valuation, because the buyer also had to confirm that this property is worth the amount that he is paying for the property then. CGT, or capital gains tax, is declared by a seller, so referred to be a transferor, through iTax portal using either of any of the 5 returns. And this is done through a self-assessment, and the returns that are used are, in case a taxpayer wants to transfer land and building, he will then use a CGT1. And in case they are partners, which according to the Stamp Duty Act, they can be partners up to 5 in number, then they will use CGT 1P. And in case it is a transfer of shares, they will use CGT 2. And in case they are partners up to 5 in number and they want to transfer shares, then they will use CGT 2P. And then finally, there is a CGT 3, which is a return used for exemption purposes.